Hello everyone, I'm Paul Hutton, President and Wealth Manager of Hutton Wealth Management, and it's my pleasure to present our 2022 Economic Review and Outlook. Today, we will be providing a brief review of the fourth quarter of 2021, and then we're going to be discussing our economic outlook for 2022. Before we begin, it's always important to review that there are 5 key areas of financial planning. These key areas are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive wealth management practice, we try to always consider the impact of any recommendation that we make on not just in one of these areas, but in all of these areas for our clients. Today's presentation will be primarily focused on investment planning and equity markets. The U.S. stock market ended 2021 just shy of all-time highs. The S&P closed the quarter at 4,766, ending the quarter up 11% and the year up 27%. This marks the third consecutive year the S&P ended the year with double-digit returns. The Dow Jones Industrial Average closed at 36,338, ending the quarter up almost 8% and the year up 19%. Since the quick but sharp fall of equity markets in early 2020, post-pandemic equity markets have been primarily very robust. Despite many potential detrimental events, the equity market showed resilience and prevailed, rewarding investors with a notable gain. 2021 saw many of the new records broken. The S&P 500 had 70 record closes, and the Dow Jones also saw some significant gains with 45 record closes. Stock valuations have soared, and many analysts are crediting ultra-low interest rates and massive government spending to the economic recovery for this surge. As you look at this 40-year plus chart of the Dow, you can easily see the stocks have increased over the long term, notwithstanding market pullbacks and dips. The sharp decline of the 2020 looks a lot less threatening as you look at it in the long-term results. That's why having a solid investment strategy is an integral part of a well-devised, long-term financial plan. Staying disciplined and not getting emotional and following your strategies during times of volatility can be crucial and is very important. While investors enjoyed an overall strong return for 2021, as the monthly S&P 500 return chart shows, monthly returns were very inconsistent. Equity markets do not move in a straight line. I wish they did. And the past few years have been an excellent reminder for investors to be prepared for anything that could affect economic environments and their own personal situation. Volatility is just part of the investment experience, and seasoned investors understand that. Let's take it bond yields. Bond yields for 2021 were low. In mid-March, we saw the highest 20 and 30-year yields on U.S. Treasuries for 2021. Subsequently, they dropped back down, ending the year at 1.52 and 1.94% and 1.9 for the 10, 20, and 30-year yields, respectively. 2021 was not a great year for bond holders. While today's interest rates are still historically low, the Fed is expecting to raise interest rates several times in the next 2 years. When interest rates rise, the demand for bonds typically falls, reducing their prices and raising their yields. Thus, 2022 will be an interesting year for bonds. Research is indicating that Treasury yields could go up, ending 22 with a 1.5 to 2% yield on the 10-year Treasuries. As I mentioned earlier, interest rates continue to be ultra low throughout 2021. These rates clearly are undesirable for income-seeking investors. Bank money markets and the average 12-month CD rates were both less than 0.2%, which is very unattractive to savers and investors. Nobody can live on that. During the Fed's Open Market Committee meeting in December, it was announced that the Fed funds rate would be increasing in 2022, and the Fed expects 3 rate hikes this year, followed by 3 more in 2023. We'll just have to wait and see what they actually do. But the speculation is projected to end by 2023, and the Fed rate will raise to 1.6 and 2.1 by the end of 2024. The Fed has been making lots of moves. They've also begun tapering, the tapering process this past fall, with the ultimate goal of ending the pandemic-driven stimulus by mid-March of this year, several months earlier than they had originally goal, which was in November of 2022. In December, due to the elevated labor markets and inflation pressures, the Fed decided to double the pace of the reduction in the asset purchase began in mid-January. Inflation at the fastest pace in nearly 4 decades in December 2021. The number reported was 7% versus the prior year. Seema Shah, the chief strategist at Principal Global Investors, stated, "Inflation at 7% is no joke. It's the highest annual number since 1982 and is driven not by energy prices, but just by everything else." While analysts feel December's numbers could mark the peak for annual inflation readings amid signs that supply strains are easing, other experts suggested that the rampant spread of the Omicron variant could bring about new difficulties for the global supply chain. Many analysts feel the tapering process in the Fed could slow inflation. Inflation is clearly on our watch list for 2022. So what are the analysts forecasting for 2022? Boy, your guess is as good as mine, but here's some things that they've come up with so far. 2022 could be a pretty volatile year, and our goal is to keep our clients appraised of any potential activities that may affect their financial situation. In addition to continued COVID concerns, 2022 is projected to bring rising interest rates, continued but not hopefully lower inflation, stimulus tapering, and a slowdown of the global economy. Also, let's not forget any public policy and new tax law changes that will bring changes to the monetary policy. Well, what does this all mean for investors? The returns that we're having, or that we have enjoyed in the last few years, were all well above average and above the typical median of the past 20 years. However, there's still many economists that feel with rates still low, we should be very optimistic and could still be looking at a favorable returns, just in more moderation. While the most recent variant of the coronavirus, the Omicron, is being seen as much less of a threat as its predecessors, and the vaccines are now widely distributed, it is still a central figure in the direction of the economy and its recovery, and it's had some effects here recently on the stock market. We were reminded in November, when the news of the Omicron was released, that the markets are still very vulnerable to the trajectory and the coronavirus and the introduction of new variants, as it directly affects the supply chain disruptors, labor shortages, and other downward pressures. Even though the equity markets have seen impressive returns, complacency should not settle in the investors' attitudes toward their investment strategies. We are still standing by our mantra of proceed with caution. We still maintain that an educated client is our best client. So here are some things that we are looking at. With interest rates on the rise, we feel it's very beneficial to you and to everyone as well to review all of your income producing investments. Look at them. Let's just take a look at them, review them. We need to lock in any mortgage rates or consider refinancing to get a better rate if you haven't done so already. Interest rates are still very low. We need to maintain liquidity for all near-term needs. I always recommend 3 to 6 months of your annual needs to be in some kind of a savings account. Reevaluate and confirm your cash flow needs. So I'll be happy to sit down and do that with you if you need help. Sometime this year, we need to conduct a full review of your financial plan. During this review, we can look at your risk management. We can talk about how well diversified your plan is, and we can revisit your time horizons to make sure that all of these items are still compatible with your goals. Remember, if volatility returns this year, it is part of the investment experience. Market pullbacks and downturns are not uncommon. Having a long-term strategy and staying away from emotional investing decisions can help you ride the pullback waves and stay on track toward your financial goals. As a reminder, focus on your time in the market, not timing the market. For example, selling equities during a downturn can help you retain your gains, but if you're still on the sidelines during an upswing, it could prove to be bad overall performance of your portfolio. If you have questions or concerns, now is a good time to revisit your financial plans with us, including your time horizon and your risk tolerance. Guys, as a recap, equity markets ended on a high note in 2021, despite many potential negative variables. We're very pleased with that. We do believe that inflation is still expected to be pretty prominent in 2022. And we also believe that the Fed is going to be announcing, and we should expect 3 rate hikes in 2022. We're probably going to see the first one in March. Tapering efforts of the Fed will double starting in mid-January. Volatility could be on the horizon, and I would expect to see it around each Fed rate hike. Cautions and vigilance are critical. You should focus on your own personal goals and objectives. And as always, call us if you have any concerns. So I want you to understand what you can expect from us. One of our main focuses is to review changes for our clients on an ongoing basis. You can expect regular communication from everyone in our office, more frequent discussions, and you can expect that we are continuously reviewing economic, tax, estate, and investment issues for all of our clients. In fact, we will be offering other workshops that highlight tax changes and planning ideas. We appreciate all of our clients. In fact, we love our clients. As a client benefit, you can add the names of our distribution list for viewing of this workshop and other workshops in the future. We hope that you will take advantage of this and add 1 or 2, 3 names or more to our list. One of our goals in 2022 is to help more people just like you. Some of our best clients were referred to us by existing clients. We want you to feel comfortable with sharing the names of anyone who you feel could benefit from this information. We believe that the best client is an educated client. Our goal is to keep you informed, and we thank you for watching this update. Best wishes for a great and healthy 2022. Please call us if you have any questions. Thank you for listening to this workshop. We appreciate the opportunity to assist you with your financial needs. Please let us know your preference on meeting format, whether you like them in person or if you like virtual. We want to accommodate everyone. Remember, at our firm, our clients come first, and your health and well-being is our highest priority. Thank you and have a good day.